You're listening to Uranium Spotlight Podcast, sponsored by Purepoint Uranium Group. If you're following this market closely, you'll want to explore Behind the Curve, understanding when and how the uranium market turns, a new white paper that shows investors how to spot the cues that come before uranium prices move. And now, your host, Chris Frostad.
It's January 13th, 2026, and this week on Uranium Spotlight, spot prices continue to firm in a thin market. Major technology companies move deeper into nuclear power, policy support accelerates across key U.S. states, and physical uranium buying quietly tightens supply. The uranium spot price closed last week at $82.55 a pound U3O8, up slightly from $82 the prior week. While the price move was modest, it occurred in a market where available supply remains limited and seller participation is restrained. Spot market liquidity continues to be thin. Producers remain focused on meeting existing contractual commitments and show little interest in supplying discretionary pounds. Intermediaries are cautious with inventory, and utilities remain selective in their spot activity. In this environment, pricing is increasingly sensitive to marginal transactions. Long-term prices were unchanged last week, underscoring the current market dynamic. Spot prices are doing the work of signaling tightening conditions, while term prices lag as utilities assess coverage needs, delivery timing, and risk. Trading patterns suggest a market tightening quietly rather than dramatically. There's no evidence of panic buying, but there is also little indication of surplus material being offered. This behavior is consistent with earlier stages of uranium market tightening, where prices tend to move in steps rather than through sustained momentum. For investors, the key takeaway is that price firmness is being driven by physical availability, not sentiment. In a low-volume environment, even small purchases can influence price, reflecting a market where optional supply has already been reduced. The steady tightening we're seeing now is one of the cues discussed in Behind the Curve, the white paper that shows investors how to recognize when uranium's real move is about to start. Get it at uraniumspotlight.com. One of the most consequential developments last week came from Meta, which announced agreements to secure 6.6 gigawatts of nuclear power by 2035, working with a mix of advanced reactor developers and established nuclear operators. The agreements include partnerships with Oklo and TerraPower alongside existing reactor operator Vistra, and build on Meta's earlier nuclear power deal with Constellation Energy. Taken together, Meta now positions itself as one of the largest buyers of nuclear power globally. To put this scale in context, 6.6 gigawatts is equivalent to 6 or 7 large conventional reactors, or potentially as many as 20 small modular reactors. If Meta was a country, its nuclear portfolio would place it among the top nuclear power producers worldwide. What makes this development especially important is that it moves demand from intention to commitment. These are long-term agreements backed by balance sheets capable of tolerating construction risk, cost inflation, and long development timelines. Meta has been explicit that the goal is to secure reliable baseload power for data centers, particularly those supporting artificial intelligence workloads. In doing so, Meta reinforces a growing trend in which non-utility buyers are entering the nuclear market with urgency, scale, and long-term planning horizons. For investors, this matters because it introduces a new class of buyer into an already constrained fuel cycle. These buyers are not motivated by short-term price fluctuations and compete directly with utilities for long-term access to nuclear fuel. Policy support for nuclear power advanced meaningfully last week in the United States. In Illinois, Governor J.B. Pritzker formally ended the state's moratorium on new nuclear reactor construction. In New York, Governor Katie Hochul committed the state to building 5 additional gigawatts of nuclear capacity. These announcements are notable not only for their scale, but also for their political context. Both decisions came from Democratic leadership, reinforcing the view that nuclear energy is no longer a partisan issue. New York's commitment alone would represent one of the largest state-level nuclear build-outs in decades. Combined with Meta's stated interest in sitting reactors across the broader PJM region, the U.S. East Coast is rapidly emerging as a focal point for new nuclear development. Illinois' decision is equally significant. As one of the largest nuclear-powered states in the country, lifting the moratorium created optionality for life extensions, uprates, and new builds, particularly as electricity prices continue to rise. For investors, the message is clear. Political resistance to nuclear power is declining, not increasing. As policy barriers fall, the primary constraint shifts back to fuel supply, construction timelines, and the availability of uranium. Last week, Sprott Physical Uranium Trust added 100,000 pounds of U3O8 through purchases in the spot market. While that volume is modest relative to annual uranium demand, it is meaningful in the context of today's thin and disciplined spot market. With limited material available and producers largely focused on fulfilling existing contractual obligations, incremental buying by financial players continues to remove what little optional supply remains. In this environment, purchases of this size can have a disproportionate impact on price behavior. Sprott's activity is not occurring in isolation. It reflects growing confidence that current prices do not yet fully reflect tightening fundamentals and that available spot material is becoming harder to replace. This dynamic reinforces what the spot market has been signaling for some time. Liquidity is limited, seller discipline remains intact, and incremental demand is increasingly impactful. For investors, the big message is that who is buying matters as much as how much is being bought. When a well-known long-term financial participant like Sprott steps into a thin market, it underscores confidence in higher prices ahead and further reduces the buffer available to meet future demand.
Before we wrap up, if you haven't yet read Behind the Curve, Understanding When and How the Uranium Market Turns, it's worth your time. It explains the real signals that reveal when uranium prices are about to move, long before the headlines catch up. Order your Behind the Curve white paper at www.uraniumspotlight.com. You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by Purepoint Uranium Group. While our passion for this sector is undeniable, remember that nothing discussed here should be taken as investment advice. Our goal is to provide a clear and balanced view of the factors influencing uranium prices. Join us again next Tuesday for Uranium Spotlight.